Okay, let's dive into this. Welcome to today's Explainer. We're going to break down some absolutely crucial rules of money management, saving, and investing. But look, we're not using any complicated Wall Street jargon today. No way. Instead, we're taking a little trip to the jungle. We're going to look at this brilliant, kind of hilarious allegory involving monkeys, leaves, and bananas to figure out exactly how financial markets work and, honestly, more importantly, how they completely break down.
Now, you might be thinking, what could a silly story about monkeys possibly teach us about losing our life savings? Well, the answer is basically everything. The pain of losing your hard-earned money in a sudden market crash, that is very real. And whether we're talking about the housing market, tech stocks, or crypto, human beings tend to make the exact same mistakes over and over again. So by stripping away all that complex math and just looking at how these monkeys behave with their bananas, we're going to uncover the hidden psychology of investing.
Section 1. Intro to Banana Economics.
Right, so in our basic monkey economy, things start off completely normal. A monkey gets hungry, wants to eat a banana, so they buy a banana for one leaf. Simple, life is good. But then, the dynamics shift. Word starts spreading that bananas are getting a little harder to find. Suddenly, the narrative becomes, banana is rare, banana's valuable. And this is the exact moment the investing mania begins. A monkey gets a seemingly brilliant idea. If a banana is going to cost more leaves tomorrow, why not buy extra bananas today, not to eat them, but just to sell them to other monkeys later for a quick profit? Speculation has officially entered the jungle.
So the crucial point is this. What we're actually watching for is a financial bubble. This happens when the price of an asset, in our case, a banana, goes up way, way beyond its actual fundamental worth. I mean, a banana's real value is literally just as a piece of fruit to eat. But because these monkeys are buying them purely to sell to someone else for a higher price, well, the price just completely disconnects from reality.
Section 2. FOMO and Herd Behavior.
This all boils down to an incredibly powerful psychological force. FOMO, or the fear of missing out. As the banana price jumps from 2 leaves to 5 leaves, suddenly the monkey news channels are giving out banana tips. Monkey influencers are doing banana commentary. Everyday monkeys see their neighbors getting rich quick, and they just start to panic. They don't even understand why the price is going up. Actually, scratch that. They don't even care why. They just worry that if they don't buy in right this second, they'll be left behind while everyone else gets wealthy.
Just look at how rapidly this accelerates the price. Day 1, a banana is 1 leaf. By day 2, it's 5. Day 5, it's 20. By day 10, a single banana costs 50 leaves. It's wild. This perfectly illustrates herd behavior. If lots of monkeys make the same decision, it feels like the right decision, even if it logically makes 0 sense. It's a classic loop of monkey see, monkey do. Monkeys buy bananas, which makes the price go up, which makes more monkeys buy bananas, making the price go up even more. Everyone somehow convinces themselves that the price can literally only go up.
Section 3. The Dangers of Leverage.
But think about it. How do everyday monkeys even afford a 50-leaf banana? Well, to keep buying these crazy expensive bananas, monkeys start using leverage. Leverage simply means using borrowed leaves from the monkey bank to make bigger investments than you could ever afford on your own. It sounds like a super fast track to wealth, right? But as we're about to see, leverage acts like a giant air pump inflating our market bubble to some incredibly dangerous extremes.
Now, what's really interesting about this slide is the math. Let's break down exactly why borrowing is just so risky. Say you invest 100 of your own leaves, and the price goes up 10%. Awesome, you have a solid 10% gain. If it goes down 10%, you suffer a 10% loss. You're a bit sad, but you survive. But if you use leverage, say putting in only 10 of your own leaves and borrowing 90 from the bank, a 10% price increase means you double your actual money, 100% gain. You feel like an absolute investing genius. But if the price drops just 10%, your bananas are only worth 90 leaves, and you still owe the bank those 90 leaves. Your entire 10-leaf investment is totally wiped out. You're left with absolute zero, and you're potentially trapped in debt.
As the source brilliantly puts it, if hype is the bubble, cheap loans are King Kong with an air pump. When leveraged monkeys see prices rising, they feel incredibly smart. So what do? They borrow more to buy more bananas. This pushes the price up even further, which makes their current bananas worth more, which amazingly allows them to borrow even more leaves. This super dangerous debt-fueled loop pumps the price of a single banana up to a staggering 100 leaves.
Section 4. When the bubble bursts.
Let's move to and see how this builds into the complete life cycle of a financial crash. What we just watched follows 4 exact stages. First, discovery. A new thing is found. Second, the boom. Lots of monkeys start buying in. Third, mania. Literally every monkey thinks this new thing will make them infinitely rich. And finally, step 4, panic. At 100 leaves per banana, monkeys suddenly look around and remember that, wait, bananas actually just grow on trees. They really aren't that rare, and they definitely can't eat all these bananas. The illusion just completely breaks.
And the price, it completely collapses all the way down to just half a leaf, 0.5. So how did it drop so far, so incredibly fast? Well, remember that leverage we just talked about? As the price dips even slightly from 100, the monkey banks start panicking. They demand their borrowed leaves back immediately. This forces the monkeys to sell their bananas at literally any price just to cover their debts. And this massive flood of selling makes the price drop even further, which triggers more banks to demand their leaves, which forces more monkeys to sell. It's just a catastrophic downward spiral all the way to the absolute bottom.
When the dust finally settles, the jungle is totally divided. On one side, we have the winners. These are the rare monkeys who bought early and actually managed to sell before the burst, or maybe those who actively bet against the price. But you know who the most reliable winner is here? The monkey who just took a nap. They simply saved their leaves, stayed completely out of the mania, and kept their wealth perfectly intact. Contrast them with the unfortunate majority on the right, the losers. These are the everyday beginners who bought in late because of FOMO, paid way too much, and terribly, those who borrowed from banks and are now hopelessly stuck in debt, holding onto a bunch of rotting bananas.
Section 5. How to spot a bubble.
We definitely don't want you on that losing side. So let's turn these jungle lessons into some practical protection for your own real-world wallet. Here's your quick beginner's checklist for spotting a financial mania. Red flag number 1, if you see average people around you suddenly making money incredibly easily with no real skill, pay attention. Number 2, if everyone is suddenly taking out loans or maxing out credit to invest in the exact same asset. Number 3, if the market is just going completely out of control with hype. And number 4, this is perhaps the biggest warning sign of all, when everyone around you starts saying the price can only go up. When you see these signs, folks, you're almost certainly looking at a bubble.
However, it is super important to clarify that not every new trend is a fake bubble. Sometimes a new thing is an actual breakthrough. For instance, when monkeys discovered electricity, it fundamentally improved their lives, right? Kept them warm, provided light. It had real, undeniable utility. But contrast that with a hype-driven bubble like the AI monkey mentioned in our source story. This smart monkey claims it can do taxes and draw art, but the writing is wrong, the drawing is weird, and it drinks way too much water. Most importantly, it doesn't actually generate any real leaves of its own. It only looks rich because big corporate banana companies are constantly handing it leaves to keep the illusion going. You really have to learn to distinguish between a breakthrough that creates real value and a bubble built purely on hype and corporate backing.
And this brilliantly illustrates the absolute core takeaway of this entire explainer. Bananas are for eating. A bubble happens when the price of something separates entirely from its actual fundamental value. Whether it's a banana, a house, or a share in a new tech company, it ultimately has to provide real value. It has to be eaten. So never fall for the hype. Never invest money you don't have into something you don't understand just because everyone else is doing it.
So I want to leave you with this final thought to consider for your own financial journey. History tells us, for sure, that another market mania is always just around the corner. It's inevitable. The herd will start running, the FOMO will kick in, and the banks will eagerly start lending. When that day comes, and the hype is just deafening, will you be the one making smart, grounded choices with your savings, or will you be the monkey left holding the banana? Thanks so much for watching. Keep your leaves safe and invest wisely.